Are you thinking of investing but scared of getting burned? Not sure where to start or how to choose the right investment vehicle? It's common to be unsure where to start when investing for the first time. Index funds versus mutual funds versus ETFs. Which one is the undisputed champ? Fear not, for in this video, this battle of heavyweights is about to start, with one option dominating the rest. We'll explain exactly why this unassuming contender consistently crushes its opponents, all while cutting fees. You'll walk away ready to invest with clarity, unlocking the markets as a beginner. So buckle up. We're about to step ringside as three titans clash head-to-head for your investment dollar. But only one walks away with the belt. Listen closely as we crown the victor. But before round one starts, go ahead and smash that subscribe button to join our MoneyWise investor community. First up, what sets these three investment options apart from ordinary stocks? Simply put, when you purchase an individual stock, you are buying shares of ownership in a single company. Your returns are entirely dependent on how that specific company performs. If the stock price goes up, your investment gains value. But if the company struggles and the stock declines, so does your investment. Buying individual stocks offers the chance for outsized returns if you pick winning companies. However, it also comes with more risk because each stock can have high volatility. If the company falters for any reason, you absorb the losses. As opposed to ordinary stock options, exchange-traded funds, ETFs, offer instant diversification by tracking an index or sector rather than an individual company. An S&P 500 ETF provides exposure to 500 large U.S. companies. Other ETFs follow sectors like technology, healthcare, etc. This diversification lowers risk compared to individual stocks. ETFs trade on exchanges just like stocks, offering intraday liquidity, and they provide market-like returns while keeping fees and expenses low in most cases. However, ETFs won't see the same potentially outsized gains as concentrated bets on hot stocks. Index mutual funds are similar to ETFs in that they track market benchmarks rather than picking individual securities. An S&P 500 index fund mirrors the performance of the S&P 500 by investing in all 500 companies in proportion to their market capitalization. The key difference from ETFs is that index funds are priced and traded only once per day after markets close, and they generally have slightly higher expense ratios than comparable ETFs. Index funds offer broad diversification and market-like returns for low costs. Actively managed mutual funds involve a professional fund manager selecting individual stocks or bonds within the fund. The goal is to outperform the overall market through security selection. However, numerous studies show most active mutual funds fail to beat their benchmarks over the long run when factoring in fees. Actively managed funds also charge higher expense ratios to pay fund managers and analysts. These extra costs eat into returns. Index funds have earned their place in the championship bout through decades of proven performance. Let's examine the key strengths that index funds bring to the table. First and foremost is the rock-bottom low costs. Index funds don't attempt to pick individual stocks or time markets. There's no paid fund manager claiming superior stock-picking skills. They simply track a market index like the S&P 500. This passive strategy keeps expenses extremely low. The average index fund has an expense ratio of just 0.05%, compared to over 1% for actively managed mutual funds. That's less than $5 annually in fees per $10,000 invested. Over decades, those tiny fees add up through the power of compounding. According to the Securities and Exchange Commission, over the past 10 years, index funds as a category have outperformed approximately 80% of actively managed funds. Index fund giant Vanguard estimates the average actively managed fund underperformed comparable index funds by approximately 1.5% annually over the past 15 years due to this fee savings alone. This cost advantage accumulates into higher overall returns compared to pricier actively managed funds. As investing legend Jack Bogle once said, "The miracle of compounding returns is overwhelmed by the tyranny of compounding costs." Minimizing fees maximizes growth. In addition to cost, broad diversification is another advantage for index funds. They provide exposure to hundreds or even thousands of securities across a wide variety of sectors, market caps, and geographies. This minimizes portfolio volatility and risk compared to picking individual stocks. A total stock market index fund, like the Vanguard Total Stock Market Index Fund, VTSAX, covers over 3,500 U.S. stocks. It'd be extremely difficult for an active manager to match that level of diversification stock by stock. Index funds take the guesswork out of building a diversified portfolio. Index funds also simplify the investing process. No need to continually monitor news and earnings reports or research complex financial statements. Just buy and hold for the long run. Passive investing on autopilot lets you focus energy on other pursuits. In the opposite corner, actively managed mutual funds promise the flexibility to adapt to changing markets. But in practice, most fail to consistently outperform comparable index funds after fees are taken into account. As Warren Buffett wisely said, by periodically investing in an index fund, the know-nothing investor can outperform most investment professionals. Here are some popular index funds: the Vanguard S&P 500 Index Fund, the Fidelity Zero Total Market Index Fund, International Index Funds. Clearly, index funds make diversification, passive investing, and minimizing fees incredibly straightforward. No stock-picking expertise is required. For the passive investor focused on minimizing costs and broadly diversifying, index funds possess powerful advantages. Their patience and discipline have steadily accumulated value over decades. But will they ultimately emerge victorious when the final bell sounds? Keep watching as the battle continues. All right, gained value so far? Go ahead and smash that like and subscribe button. Now, on to actively managed mutual funds. With mutual funds, professional managers hand-pick baskets of stocks, bonds, and other assets. The goal is to try and beat the overall market through savvy security selection. Some mutual funds focus on specific sectors, industries, countries, or asset classes. For example, some key types of mutual funds include sector funds, international funds, bond funds, balanced funds. With thousands of mutual funds to choose from, investors can target very specific asset classes and strategies. The promise of mutual funds is market-beating returns from the manager's stock-picking skills. But there's a little downside. You pay dearly for that access to their expertise, with the average mutual fund fee over 1%. That's 10 times higher than many index funds. After decades of compounding growth, those fees eat into returns. According to a 2022 Morningstar report, after fees, just 24% of active U.S. stock mutual fund managers outperformed their index benchmarks over the past 10 years. As legendary investor Peter Lynch said, "Far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves." All right, still here? Then we suppose you're gaining some value from the video. However, if you are yet to subscribe, could you take a second to hit the subscribe button? Now, on to ETFs. ETFs, or exchange-traded funds, have surged in popularity over the past decade, with over $7 trillion invested worldwide. Like index funds, ETFs track market indexes or sectors, rather than trying to beat the market. But unlike mutual funds that trade only once per day, ETFs trade on the stock exchanges throughout the day, just like individual stocks. This trading flexibility provides easy liquidity to buy and sell on demand. ETFs maintain key benefits of the index fund structure: diversification, low costs, transparency, and tax efficiency. Expenses are minimized without a paid stock-picking manager. Here are some key types of ETFs: market ETFs, sector ETFs, commodity ETFs. With thousands of ETFs available, you can target precise asset classes, sectors, and strategies. Benefits like trading flexibility and tax efficiency make them excellent investment vehicles. Now for the verdict on which option wins as the best choice. Think of it like cars. Mutual funds are like luxury vehicles with all the bells and whistles, but higher sticker prices and costly maintenance. ETFs are like affordable sports cars with great performance for the price. But what about index funds? They're the long-lasting, reliable sedan that will get you safely to your destination, without the huge price tag and the flash. For simplicity, minimizing fees, passive investing, and harnessing decades of compound growth, index funds take the trophy. With rock-bottom costs, diversified market exposure, stress-free set-it-and-forget-it approach, and time-tested results, index funds are ideal for most goals-focused investors over the long haul. If you have money to invest today and want to buy index funds, the first step is opening an investment account. The two main options are online brokerages like Fidelity, Vanguard, and Charles Schwab, or directly through investment providers that offer index funds like Vanguard, Fidelity, etc. Opening an account with an online brokerage can provide access to trade various securities like stocks, ETFs, mutual funds, and more, including index funds. Leading discount brokerages offer excellent platforms and account options fit for any investor. The account opening process is straightforward and can usually be completed online in as little as 10 to 15 minutes. You'll link a bank account to transfer in money. Then you can start trading. The benefit of using a brokerage is the ability to invest in individual stocks and ETFs, as well as other fund types, all in one place. Many leading brokerages also now offer commission-free index funds to buy and sell. However, some brokers may charge higher account fees compared to going directly to a fund provider. Purchasing directly from issuers like Vanguard, Fidelity, and others focuses solely on their own family of funds. But cutting out the middleman broker can translate to lower account fees and minimums in many cases. Opening an account directly with a firm that offers index funds takes just a few minutes online. The basics of buying an index fund are the same whether you use a brokerage or go direct. You can search and screen for index funds that match your objectives. Once you select a specific index fund to invest in, you place a buy order for either a dollar amount or the number of shares. Index mutual funds trade just once per day after the markets close, unlike ETFs, which trade intraday. So your order is executed at that day's closing net asset value per share. The purchase amount will be deducted from your account balance. The simplicity and diversification of index funds make them a smart choice for beginner and seasoned investors alike, seeking to meet their financial goals.